The S&P 500 broke a 4-week losing streak to finish up 1.52% this week and closed at 3348.44. Thank you for watching this video. My name is Rodney Constable. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals is a risk management system for financial professionals and disciplined individual investors. Today we will be doing technical analysis for the week ending Friday, October 2nd, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. We will come back to this chart in just a minute or so, but first off, I wanted to really focus in on what happened this last week. So this is a really short-term chart. This is a 6-day, 5-minute candlestick chart where each candlestick represents 5 minutes of trading. The blue line is set at 33.30, and the reason I made this a 6-day chart is I wanted you to see Friday's trading from September 26th, so a week ago, and then what happened on Monday. Because we gapped up on Monday at the open, and that really, for this week, was responsible for the bulk of the gains that we saw this past week. Here is the first candle on Monday, right? So the first 5 minutes of trading on Monday, and you can see where we finished up on the last 5 minutes of trading on Friday, and you can see that there's just not a lot of difference there. So really, this 1.5% roughly gain, right? 1.52% gain for the week. It was pretty much all right there. And then as you can see, we predominantly traded sideways with some volatility for the remainder of the week. Any of you watching my videos over the last few weeks know that I've been talking about how important this 33.30 level has been. And you can see it again this week where we came down and tested it and undercut it for just a couple of minutes here on Tuesday the 29th. And then today, of course, with the news that President Trump has tested positive for COVID-19, we gapped down at the open, but in less than 5 minutes, you can see we got back above that line. So for just a couple of minutes, we traded below 33.30. And you can see in the middle of the day today on Friday the 2nd, we came down and kissed this 33.30 level again. So, and if you want more detail, and if you haven't seen my videos over the last couple of weeks, I would encourage you to go back over those. There's several of those out there really showing on intraday charts, hourly charts, and others how important this 33.30 level is. So it's super important for you guys to understand this on a go-forward basis. So the bottom line is, as long as we continue to close on a daily and, of course, weekly basis above 33.30, there's probably not a lot to worry about. But this just shows you how important this 33.30 level is. But it also shows you that, once we got back above this on Monday, we pretty much just traded sideways for the majority of the week. With that said, now let's go look at the longer-term chart and take a look at the bigger picture of the S&P 500. Okay, so in this chart, we're looking at a 2.5-year weekly candlestick chart of the S&P 500. So each candlestick represents 1 week of trading now. And again, this chart is 2.5 years long. So a lot of annotations here. So let's start with the fact that including this week, the S&P 500 has only closed 9 times in its entire history above 33.30. So that's this first blue line here, okay? And again, we just looked at how important that 33.30 level is on a short-term basis, but we can also see that we really have only closed above 33.30, right? If you're following my cursor, here's 2020. We only started to close above 33.30 on the S&P 500 over the entire history of the S&P 500. The first close above 33.30 was back in February, okay? So we had 2 closes. Pretty hard to see on this one where it was negative, but we did barely close above 33.30 there. So there's 2 weekly closes there, and if we count them, 1, 2, 3, 4, 5, 6, 7, okay? So there's a total of 9 weekly closes above the 33.30 level. That is super important to keep this in mind because we are in rarefied air here. Even though we're dealing with a pandemic and we have falling earnings for 2020 over what we had in 2019, so we've got expanding multiples, right? Price to earnings ratios have expanded, which of course is what it's allowing us to continue to close at these highs. Market valuations are high, guys. They're not too far off from where they were over 20 years ago in the late 90s. So just kind of keep this in mind that we're in rare air and we're still trading over 8% above the long-term moving average. And yes, there's some support at 33.30, but not a lot, because again, we only started to close above 33.30 this year. And the next level of support is going to be found around this 3,200, 3,210 level. And then the next level is going to be down here at this 40-week moving average. Okay, so just keep in mind that we are still in a very vulnerable place. Yes, it's great that we now had the 9th weekly close in the history of the S&P 500 above 33.30 this week, in spite of the fact that, you know, the president has tested positive for COVID, and there's, you know, a contentious presidential election about a month out. There's a lot of uncertainty out there, and yet the market has been extremely resilient. A lot of that, of course, has to do with stimulus and the hope for more stimulus. But we also need to look at, you know, potential downside, right? If the market rolls over and if we start to close beneath 33.30 anytime soon, our next level of support will be found, of course, around this 3,200 level. We know that we kissed that last week, about 32.10, bounced off of that after 4 straight weeks of negative returns on the S&P 500. But if we break below 3,200, there might be a little support at the 40-week moving average, the 200-day moving average, right? 40 weeks equivalent to that. Oftentimes, the markets will bounce off of, or, you know, stop somewhere, right? If they're correcting, stop somewhere around the 200-day, the 40-week moving average, as we see here. But the real area of support below where we are currently trading is really down around this 2,950 to 3,000 level. And this is why I made this chart 2.5 years long, so you could see that when we go back to 2018, which is when we first started to trade up to and around this 2,950 level, didn't get quite to it, but came really close. But you can see we came just below the 2,950 level there in the September, October timeframe of 2018. And we came right back to this level in, as we can see here, latter part of April of 2019, and then kind of played around in this level for a good majority of Q2 and Q3 of 2019 before finally starting to close consistently above that, where of course we had that really nice run from October of 19 until February of this year, when of course the market sold off hard. So in the short term, the market is being extremely resilient. However, the fact that we're still trading over 8% above the 40-week moving average and over 10% above where the real level of support is makes us vulnerable in the short term to any kind of downside shock. Any kind of negative news about the economy or anything like that, guys, could cause further downside in this market. So another 8 to 10% downside or more, right? It doesn't mean that we would stop here, but you know, if we fall down to this 2,950 to 3,000 level, there's quite a bit of support over the last couple of years right there. So in the short term here, I would be somewhat surprised if we go much below that. However, anything in the stock market is, of course, always possible. Before we go any further, let me ask you a question. Do you have a stock market risk management system? Something that helps you understand the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the short-term trend on an ongoing basis? Do you know the direction of the overall trend in the stock market? My system is called Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecasts, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including in numerous bull and bear markets. And what I found is that certain conditions exist during these various market phases. And then based on that information, I created simple, easy to understand signals around these different phases of the market. And the thing is that most people don't know about or have access to the data necessary to do the research that I had to do to put together this model. Now let's take a look at the signals. The red signal has the highest equity risk associated with it, and the worst sell-offs, including bear markets, will happen when the signal is red. When the signal is yellow, this means that equity risk is moderate, and sideways to slightly up or down price action is very common during a yellow signal environment. The green signal is the best signal. It has the lowest equity risk associated with it, and most all upward progress in the stock market will be made in a green signal environment. Said another way, it is very hard to make money in equities unless the signal is green. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. Now let's take a look at the first 3 months of 2020 so you can see how Simple Market Signals could have helped you in the most recent downturn. We know that we came into the year with a strong stock market, so we had a green signal for the majority of January, but on January 27th, the signal went yellow for a couple of weeks. We went back to green in the first part of February, and I warned my newsletter subscribers on Saturday, the 22nd of February, that I felt like the market was starting to roll over and that things were changing. And so I gave people a heads up right here over the weekend, and I told them that if the market continued to sell off, that we would probably see at least a yellow signal, if not worse, the following week. And that's exactly what happened. On the 24th, the Simple Market Signals risk signal went yellow. Now, one of the other things that I want to point out here is, in addition to the risk signal, I also have several trend direction indicators in this Simple Market Signals model. Now, the longer term one is called the general trend indicator, and the general trend indicator went negative on the 25th. So on the 24th, the signal went yellow. The general trend indicator went negative on the 25th, and then 2 days later, the signal went red. The risk signal went red. So think about this. All in 1 week, just a few days apart, we had a yellow signal, we had the general trend indicator went negative, and then we had the risk signal went red on the 27th. That was Thursday, all right? And by the way, this general trend indicator is a positive negative signal, and it operates totally independently of the risk signals. It's just trend. So the general trend indicator gives you still another way to monitor and control risk in your portfolio. And guys, that general trend indicator had been positive since October and then went negative. So right there, just those two signals alone told us that something was changing in the stock market. And then by the 27th, the signal had went red, and we can see here that the market fell from there. As part of the Simple Market Signals model, there are three powerful indicators. There's the Simple Market Signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in the Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signals subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an emailed newsletter, so we will have to have your best email address on file, and make sure this box is checked because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. Now, when you subscribe, okay, understand that everything is tied to your email on file, all right? So once you subscribe, you go out to the website, simplemarketsignals.com, and it'll take you maybe 5 minutes to subscribe. It's pretty easy, and you just follow the prompts, and then your email on file is then going to drive everything going forward. This is an emailed newsletter subscription. That's how we disseminate the information, and you should get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter that is automatically generated once you subscribe. So if you don't get that welcome letter beyond your confirmation, okay, of the subscription, if you don't get that welcome letter, if you don't see it in your in basket, then go check your spam, your junk, or your promotion folders, especially in Gmail. Having a lot of people that are having the newsletters and everything coming from Simple Market Signals going into the promotion folder. So please make sure that you check your spam, your junk, and your promotion folders. And also understand that the newsletters go out on the weekend. All right. So the goal is to get it out Saturdays by 2 p.m., but it could be any time over the weekend, depending on how long it's taken me to do the research necessary for that week's newsletter. But I try to get it out by 2 p.m. Eastern Standard Time every Saturday if I can. Again, earlier if I can make that happen. And then the next edition, right, once you subscribe, understand that the next edition, right, so if you just subscribe on a Monday, Tuesday, Wednesday, whatever, the next regular edition is going to be set out on Saturday. All right, and then once you subscribe, we will send you as soon as we can the latest edition, but we have to send that out manually. So just be patient with us. But again, within a day or two of your subscription, if you don't get this latest edition, then go back and check your spam, junk, and promotion folders, because it's probably hidden in there. All right. So you should get the automatic welcome letter and then the latest edition within the next day or two of your subscription. And then again, the standard newsletter goes out every weekend, but we try to make it no later than 2 p.m. Eastern Standard Time on any Saturday.